stock market is up. Inflation is down. The Baltimore Orioles come back on a game-winning home run at the bottom of the ninth.
Who cares?
Great things are happening right now, and we are here to tell you all about it. Welcome to BTT's Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host and hopefully Baltimore Orioles fan, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
A Dodger fan from the 60s. I'm going to root for the Orioles. Why don't you just rip my eyes out?
1966, when the Orioles swept the Dodgers. Might happen again. We'll see what happens. But with us today, we have a very special guest. We have Aniket Ullal, who is the head of data and analytics for the ETF side for CFRA Research out in New York. Aniket, welcome back to Buy, Hold, Sell.
Thank you, Todd. Wonderful to be back. Great to see you again, Toby.
Yeah, and did you notice that even with the big microphone he has, he doesn't even need the microphone? I mean, he's just as loud when the big microphone is with no microphone. I have no idea.
Well, listen, I'm so excited, Toby. There's so many great things. The S&P closed above 5,300 for the first time ever. So many good things are happening. And now Wall Street traders are actually thinking we might actually have rate cuts by the end of the year. Who knows? But our guest today, I'm telling you, Aniket knows everything about the ETF side. And I know, Aniket, you're coming here. You've got a full lineup of data that you're going to share with the audience, because I can only suspect that we have a lot of inflows, new cash that's flowing into ETFs. Am I right?
That's right, Toby. We've had almost $270 billion in flows this year. I'm sorry, I'm going to repeat that. That's right. That's right, Todd. We've had almost $270 billion in inflows this year. And it's actually been one of the strongest starts for ETFs in a long time. In the last couple of years, we've had about $600 billion in flows into ETFs in the last 2 calendar years. It looks like we're very much on track to beat that. In 2021 has actually been the strongest year on record for ETFs, almost $900 billion in inflows. And if we got even close to that, I think 2024 would be a really good year for ETFs. So it's been a really strong start. We did see, of course, that from a performance perspective, the market did take a pause in April. If you look at the best performing ETFs in the last month, it's really been the more defensive sectors, utilities ETFs, consumer staples. That's all a reflection of what happened in April when the market pulled back just a little bit. But as you mentioned, inflation is moderating now. We've seen the market turn back up again in May. And both from a performance and flows perspective, the ETF market looks healthy. And certainly we're expecting growth ETFs to come back as well.
And again, didn't we have in April, though, we had something like 120 to $180 billion of withdrawals? I mean, there was a pretty sharp withdrawal from ETFs.
We haven't seen very significant withdrawals, even though the market was down. So we have seen fairly consistent inflows, at least in this year. And actually, the flows have been fairly consistent across asset classes. So, for example, if you look at the last trailing 1 month, we've had about $51 billion in inflows. Over half of that has been into equities, which kind of indicates investors are still very much in a risk-on kind of mode. We have seen money go into fixed income, but again, it's been split between corporate ETFs, corporate bond ETFs, and treasuries. This is again very unlike last year, so the beginning of last year. The first half of last year was much weaker in terms of flows relative to this year.
Well, I'm going to fire then the company that sent me this research that said that there was $200 billion withdrawn from ETFs. I'm just looking at the article right now going, all right.
Well, let's hope it's not CFRA.
Yeah, no, I'm sure.
But Aniket, with that, I mean, it sounds like with the utility side, are people favoring dividends more so? I mean, maybe that's where we saw a big jump, especially with the sell-off in April?
Absolutely. We saw a lot of rotation into dividend-oriented ETFs, essentially ETFs that provided a little bit more income kind of cushion. And so I think that explains why utilities has been one of the best performing. If you look actually in just the calendar month of April, of all the 11 gig sectors, utilities was the only sector, was actually by far the best performing sector. In fact, it was the only positive sector in that calendar month.
Yeah, let's also not forget that in the sort of 12 nonstop growth secular moves in the world, in the industrial world, we need a lot more power. And if you look at who led there. These were also the Constellation Brands, the Southern Energy, people who have significant amount of data centers, not only that they're giving power to, but are going to have even more when they actually get built. I mean, in Georgia, there's 780 gig per quarter. I mean, what I'm trying to say is ridiculous amount of new data center space in places like Tennessee, places like Ohio. And so, there was a secular demand growth, but also the companies that are building them, Eaton, Train Energy, which provides the air conditioning, on and on. Hey, they're getting free money for the government, so you would expect them to actually grow. And then when you get the data on how much energy AI data centers are going to require, and it takes 4 years to build these, new power places. And Southern just had 2 new nuclear plants come on that they've been building for 21 years. I mean, it's quite a deal. So it makes a lot of sense. Another thing I just say from the, not from the data side, but from the context side, is that, what I've been looking at is the broadening out of the market. I mean, that to me, that meant that, my miraculous 8 stocks that are up, 83% this first quarter or first half, that's awesome. Yeah. But it's really more important for us to see the rest of the market, the other, as you see, because you follow all these various ETF sectors. It was a healthy catch up. It was a healthy thing for money managers to say, okay, wait a minute. That's right. I am a fiduciary, right? I can't have people be 3x overweight on a certain class of stocks and keep my job. I was on this call with Josh Brown this morning, and everybody started talking about career risk. And if you've been dead wrong, as some of these guys, Mr. Rosenberg, or other groups that have just, completely missed the train. Yeah, I know if I do it, I get these little texts from my clients and say, "Hey, Todd, how come the S&P 500 is up X and we're behind?" Well, thankfully, they've never been able to say that. I'm just saying, suppose that they could say that. Right. But there's real career risk here. So I'm interested to see what you think are the sectors that are continue to outpace in the second half, if that's part of your forecasting.
Sure, yeah, happy to touch on that as we talk through this kind of ETF picks.
You got it.
Yeah. So Aniket, so is your data? Are you able to get data up to the day? I mean, I'm not saying you'll have inflows or outflows for today, but how current is your data?
Our data is just lagged by a day. So our data today would reflect everything as of the previous day's close. So it's very timely data, and we monitor it every day.
Wow, that's amazing. So so we went on that winning streak with the markets. We saw the 10-year yield dropping. I mean, it was obvious that when we saw the 10-year yield rising in April, that really correlated to the selling side, the selling pressure that we saw in the markets in the month of April. So I have to ask then, are you seeing big inflows, say, over just for the month of May?
We've definitely seen significant inflows out in the month of May. In the trailing 1 month, so we generally tend to look back. We have data even just for the calendar month of May, but typically we look back 1 month, 3 months, and so on. Like I said, in the trailing 1 month, we've had $50 billion of inflows into ETFs. That's a healthy number, and we see that number continue to rise. Also, that number, as I said, is spread across multiple asset classes, multiple products. The first 2 months of this year, actually, the biggest gainer in terms of flows was actually the Bitcoin ETF. Surprisingly, now it's actually that's moderated. We've seen for the first time in the last 2 weeks some outflows from Bitcoin ETFs, but significant inflows across the board into the big mega, kind of market cap weighted ETFs, IVV, SPY, as well as bond ETFs.
Yeah, I was going to ask, there's inflows into ETFs, and then there's inflows into market cap weighted ETFs that just has to have a 2 or 3x bigger impact on the market overall, since they're buying the same 10 top stocks. Do you have any data on that?
Yeah, so one thing we've seen with the market cap ETFs is that they can be very cyclical. For example, if you look at SPY, and even with those market cap ETFs, they tend to appeal to different audiences. So for example, if you look at SPY, it's much more widely held by institutional investors. It's much more an institutional vehicle. And so we tend to see a lot of inflows in SPY towards the end of every calendar year.
Right.
December is always the best month for SPY. Whereas you look at something like VOO or IBV, VOO certainly is much more retail oriented. I mean, Vanguard's products generally tend to be more retail. IBV, I would say somewhere in the middle, typically held more by financial advisors. So, it really depends on the kind of product we're talking about. But we do see that, we've seen certainly in this year that it's, like you said, it's been a very top heavy market. A lot of money going into not just large cap, but even mega cap names this year.
And does it matter that now 90% of the trades on the entire day happen in the last 15 minutes because all the ETF guys are, I mean, literally, Todd, I'm not exaggerating.
Yeah, you're right.
And NYSE put it out last week. 90% of the volume, it comes in on these, these mixed trades where they're selling and buying, simultaneously. Is that healthy? I'm just asking.
We actually don't track intraday data as much, so I'm not an expert on that. But I will say one thing, that we've seen a lot of growth in options-based ETFs. Certainly covered call ETFs, and now kind of ETFs offering various types of downside protection in exchange for an upside cap, and kind of what some people call buffered or defined outcome ETFs. And just, I think that adds more complexity as well, right? Because now you've got not just the stock trading, you've got all the options trading on top of it, kind of adding to that activity. So yeah, I would say, yeah, that's certainly a concern.
Well, in theory, that was supposed to make the VIX go up, right? The volatility index, that was supposed to make go up, which all it's done is gone down. So there you go for that theory. Right?
But you do bring up a good point, though, Toby, is that what happens if you are the fund manager of the ETF? Are you looking at the net amount the day before, and then that's going to tell you how much cash that you have to invest that day? Or are you looking up to the hour? I mean, for example, if you see a huge amount of cash rolling in by 2 o'clock New York time, then are you thinking, oh yeah, I have to deploy this cash over the next 2 hours, and I'm going to go in the last 15 minutes? I mean, I would think that would be a signal then of something else that is taking place.
It's just making me laugh a little bit, because like in the old days, when I did this in like the early 2000s, the cash was in, we invested it, and we didn't care. And there was no market moving, aspect, certainly for the funds I was running, but it was just easy to deploy. I couldn't imagine getting $4 billion in one day.
Right.
And you're on a market, weighted index. And I guarantee you, there's a button that they push that executes all those trades. And that's why it's in the last 10 minutes. Because you saw what you have to put out today. You saw what came in. You push that button. There you go. Now put that to work. Click. And you're getting paid $300,000 a year to do this. Click.
Yeah, exactly. Wouldn't that make you crazy? I mean, that kind of cash. I mean, Aniket, you can't pinpoint it, can you? I mean, where that money's coming in up to the minute, though, are you?
No, we don't track it at that level, but I can certainly see that adding a lot of complexity to kind of a fund manager's situation. Yeah.
So I want to leave you just one last question before we go to the break. So,
how's the time, Todd? I'm very worried about the time.
Okay. Well, you work alongside Sam Stovall, where Sam is we're big fans of Sam. He's been on Buy, Hold, Sell several times. Do you work with him and say, okay, we had X amount going into equity ETFs. This could be the sign of a top, and therefore he's going to then relay that in his commentary?
So Sam, actually, we have various divisions at CFRA that all inform what Sam does. So we have the ETF data. Obviously, I share that with Sam. He actually accesses it every day, and that feeds into his process. We have a technical research group, Lowry Research, that we bought a couple of years ago, that also feeds in. We have a whole fundamental team. So what he does is he'll take in the ETF data that he gets from me, and my area. He'll take in data from our technical group. He'll take in data from a fundamental group, and then that all feeds into our kind of broader outlook. And essentially that allows us to then put in our 12-month or year-end projections.
Todd, I want to point out that CFRA is owned by S&P Global. S&P Global bought my company, ChangeWave Research. Actually, my old company is what's driving this company.
Absolutely. It is the octane that's driving that bus. That's for sure. Well, listen, let's leave it there on this block, guys, because coming up next, Aniket, he came prepared. He has 4 big-time ETFs that you want to be focused on. He's going to break them down for us, tell us all about them, and I think you're going to get a lot out of them as well. So with us today, Aniket Ullal, who is the head of ETF Data and Analytics over at CFRA Research, and we'll be right back right after the break. Please stay with us.
Buy, hold, sell, brought to you by Crosscheck Management.
Watch 13 Wham News anywhere on any device with Stir. Download the Stir app and choose Rochester. You get local news and more than 20 other TV channels. And the best part? It's free. Go to your app store and download Stir today.
Welcome back to BTT's Buy, Hold, Sell. Well, what can we say? The S&P 500 up over 5,300, and it doesn't look like it's going to be slowing down anytime soon. And our guest today, he is the head of ETF Data and Analytics, and he's telling us that he's seeing a huge amount of inflows into these equity ETFs. Aniket Ullal, who is with us, still with us from the first block. And Aniket, you came prepared. You told us about 4 big-time ETFs that you're tracking right now. Tell us about this first one, because this really goes right into what Toby's been talking about on Buy, Hold, Sell for a very long time about these shipping companies, or shipping containers. So maybe I'll give the floor to you and you tell us.
Good. Let him get some breath. Let him catch his breath here, honestly. To be able to speak that long on one breath is really,
But go ahead.
Thank you, Todd. When I pick ETFs, I like to pick ETFs that actually are focused on particular themes that I think are here for the long run. And one of the beauty of ETFs is they allow investors to track particular themes, strategies, and factors that they are bullish on. So the first one I picked was actually the SonicShares Global Shipping ETF. The ticker is BOAT, B-O-A-T, easy enough to remember. There's another ETF that's similar that also includes some air freight companies, that's SEA. Both of these ETFs have actually done really well recently. I think BOAT is up about 20% this year, clearly outperforming both the broader transportation industry as well as the 500. And the reason I picked it is for a couple of reasons. It's clear that the outlook for global merchandise trade this year is much more positive than it was last year. The World Trade Organization actually put out an interesting report last month looking at global merchandise trade. Last year, by volume, global merchandise trade, not including services, actually fell by 1.3%. This year, they're projecting it to grow by 2.8 or 2.9%. That's a pretty significant turnaround. By volume, last year, it actually fell by 5%. So there's much more optimism around global trade. As you know, there's been a lot of geopolitical issues, particularly around traffic through the Suez Canal, which accounts for about 12% of all trade by volume. There have been some ships now going around kind of the Cape of Good Hope to taking alternative routes, and a little bit more stabilization around that. In fact, the World Trade Organization report actually had a whole section around what's happening in the Suez Canal. So overall, it looks like things stabilizing a little bit. There are geopolitical risks even now, but we do like the sector, and it's certainly been performing well recently.
Yeah, I've been, Todd, I've been talking about the LPG tankers in particular. Today, the one I've been talking about since it was like, I don't know, $5 advanced LPG, closed at $17, announced a $1.30 dividend, and that means 260. So they're going to deliver $5.20 of dividend on a $16 stock. And there's 2 reasons for that. Aniket talked on both of them, but build it out a little bit here. There's an X amount of ships, whether it's container ships or whether it's bulk carriers, whatever, or tankers. Now we own a lot of tankers as well. The problem is when we came in and out of the pandemic, all of a sudden rates on container ships literally went from $3,000 a day to $100,000 a day for a 20-foot container. Nothing like that's ever happened in the history of life, right? So being of sound mind and greed, the container business ordered this is a very accurate, a very precise word, shit ton of new ships. And they're only made in two places. They're made in Korea and they're made in Japan. So all that shipping, it takes about 5 years to get these things all built from the beginning to the end. And 90% of the ships being built are shockingly container ships. Therefore, there's hardly any new tankers. There's hardly any new LPG. And at the same time, it's not only that, you used to be able to go through the Suez Canal. Now you have to go around the Cape of Good Hope. But it adds 15 to 20 days of time. So if you have X amount, here it is, X amount of boats, and you have X plus 10% of demand, then when somebody goes to rent that boat for the voyage, and there's less supply than there is demand, shockingly prices go up. So and then the other thing, of course, we talked about for a long time is the Panama Canal. Panama Canal is still only at about 60% of the water level. So the really, really big boats pay stupid money, like the big container ships will pay $1.5 million in slotting fee. So they can go through. They have to go through very slowly. And then the big ships, like the ones that we invest in, LPG, their depth is too big. They can't go through. So they have to go around. So you add in those two factors. And geopolitical, is a inflection point of demand and pricing power. And I think that's what Anne's trying to say. And that's what I've been saying, is that we invest in inflection points of demand, inflection points of price, ability to raise prices. That's a double inflection point. More demand than supply and higher rates equals like stupid, ridiculous 21%. The other one we own is BWLP. BWLP is going to pay us 28% this year in dividends. Now tell me where you can buy something that's going to pay you 28% of dividends, sells for basically its net asset value of the boats, doesn't include the amount of cash they have in the balance sheet from just a basic investment standpoint. That now the bad news is, I always best it up in it, when the economy goes down, shipping goes down, prices go down, etc. But we're on the other side of that. We got India at high end, we got China, we have Japan, we have the freaking stock market in all of Europe hitting all-time highs. So we're long that trade, for a long time.
Right, and the symbol on this is BOAT, BOAT, and it's interesting. I love that. It's great for marketing as well. Aniket, what do they do for what are the assets in this ETF, real quick?
So it's actually not a very big ETF. It's about 52 million in assets. So it's a relatively, because it's kind of a niche ETF, but again, the performance has been strong. And as we've discussed, the last time on your show, what really matters is the liquidity of the underlying, not necessarily the assets in the ETF. And so as long as they're holding liquid stocks, and of course, this is a global ETF. It's not just US. Some of these are Hong Kong based, or maybe companies headquartered in places like Cyprus, but listed in NYSE. And so on. So the underlying is liquid.
Okay, I got that. Okay, let's move on to the second one. This Blackrock fund. I love Blackrock. Tell us though, this flexible income sounds great, but what does it mean by being flexible?
Well, actually, if you look at a lot of fixed income funds, a lot of them don't, have very rare. On the equity side, you tend to have these go anywhere funds are fairly common, right? On the fixed income side, not as much, especially in the ETF world. A lot of them tend to be focused along certain geographies, credit spectrums, duration, and so on. This is one of those rare ones that's actually actively managed and can go anywhere. What we like about this fund is that, well, one of the reasons I picked it is actually, if you look at all ETF launches in the last year and a half, this has been the most successful active ETF launch in the last 18 months. Wow. And I think the reason for this is because they're actually managed to get a pretty good yield without having to take on way too much credit risk. I mean, if you look at this ETF, just looking at the numbers here, the duration is about 2.8 years. They've got about 65% of the exposure in investment grade securities, but the yield is still pretty good, right? You're talking about like SEC yield of just under 6%. So it's a pretty good yield with not taking too much risk. And I think they've managed that trade-off between taking on some risk and reaching for yield quite well. And that's one of the reasons I picked this fund.
Well, Todd, I'd also add that I was amazed today on this call. We're talking about the fact that normally 10-year bond trades at like 125 basis points, 1.25% higher than the Fed funds rate. And today, or actually 150, 1.5%. Now it's trading 125 basis points below the Fed funds rate. So that's, again, the people who have these models that worked in the 2020s and then in the 2019, et cetera, we never had anything like what we have right now. I mean, at some point in time, we had the 10-year today at 4.32. It was 5%, 6 months ago. In theory, you may just use the bond market to decide whether you're going to have a bull market in stocks or not. But I can't explain why this difference. But I can just say that it's never happened before. So that then tells me that let's look at other things that have never happened before and not just extrapolate what did happen before. Thank you very much. I'll be here all day.
But no, that sounds like a really good one. I love it, though, especially I would imagine with, like we were talking about in the last block, about the appetite for dividend paying stocks. This seems like it'd be a winner. That would be a place for investors to concentrate on, especially if they don't feel like the markets can continue to rally, but who knows? All right, let's go to this third one. The SPDR Mini Gold Shares Trust. I mean,
Woo-hoo!
gold. Woo! I got to say, I mean, gold was hot. I mean, it's still hot, but what do you think from an ETF standpoint?
Well, I mean, look, I know picking gold is not the sexiest pick. Sometimes, when people want to see the kind of an active ETF or equity ETF pick or something, but I picked gold because I think there's some broader trends going on here with gold. One, I think, is that one of the reasons gold has done well this year is we've seen a lot more central bank purchase of gold. In the last 2 years, central banks have bought over 2,000 tons of gold. This year, actually, central banks have bought more gold year to date than they ever have before. And I think that
there's much less new gold coming onto the market.
Yes.
If they were just buying it from the miners, that would be one thing. But no, they're buying it from existing supplies, which creates a demand versus supply shortage.
Right. So I think central bank purchasing is certainly a big factor. And you can see geopolitical reasons for this, right? If you're a central bank in Asia or emerging markets, or you want to be diversified from holding just US dollars. And there's also consumer demand in China. Obviously, we've seen challenges in the property market and so on. So, consumers in some of these markets are buying gold as well. It's considered a store of value in many of these kind of Asian markets. So I think there are underlying factors for that kind of underlying the demand for gold. So will that continue? I mean, obviously, some people see gold as an inflation hedge. Last year, that didn't quite work out. But this year, certainly gold has been strong.
That's another failed model. Todd, let's do just a show on the failed models of the 20th century that are being applied to today. So the other big issue, remember, in China, their stock market has, here's a technical term, really sucked for the last 3 years. If you've ever been to China and you're in Beijing and you go to a trading house, you'll see the trading going across this big window outside, and there's all these old guys and women trading stocks on their Huawei phones. They don't use iPhone. They are stock junkies like nobody's business. They're also gold junkies. Now, when the stock market is SUCKING, they have been buying gold because it's the only thing left. There's not enough silver, for God's sakes. We own silver because, since they make all the solar panels that we can't afford to make because they make them so cheap. There's like 2.1 pounds of silver for every one of those things. It's a huge utilizer of silver. Not so much gold. Gold is a central bank trying to de-dollarize their reserves by having in gold. Not to be, essentially subservients of the United States dollar, because we're so popular around the world, as you know, and it makes sense. The problem but for instance, gold miners is we own GDXU. That's what we've done very well in that. But the cost of taking gold out of the ground today versus, again, 20 years ago are significantly higher, starting with energy prices, starting with labor prices, et cetera, et cetera. So the margin in opening up a new gold mine right now is not very good, and the existing ones are just taking the easiest stuff they can take out. So that also creates a supply-demand imbalance. And So I love being Mr. Fundamental and you're Mr. ETF. See, we get both sides.
There you go. There, absolutely. All right. Well, let's get to the fourth and final one because the audience is on the edge of their seats for this one. This
sit down,
York,
people. Sit down.
This bank, sit down. That's right. This Bank of New York Mellon Infrastructure ETF. Aniket, got to get into this one with us.
Yeah, sure. So I think infrastructure is an interesting theme for the longer term. We've seen actually this play out even at a strategic level. If you look at the big asset managers, as you know, BlackRock made a big acquisition of an infrastructure fund. Of course, that was a little bit more private market focused. But I think one of the reasons I like this fund is it's got two components to it. It's got the traditional kind of what they call the traditional opportunity set, which is a little bit more focused on, like, for example, utilities and things like that, which as Toby mentioned earlier, goes beyond just, there's many factors driving demand for that. And then there's what they call the non-traditional opportunity set, right? These are infrastructure companies in things like telecom and data centers. And so this fund actually has exposure to both sides of it. I think the reason it's done well recently is probably more because the utilities exposure. Like I said, utilities has been the best performing sector in the trailing 1 month. But I like the fact that it's set up with both legs of infrastructure. And I mean, look, infrastructure, there's many things driving demand for it.
Okay.
Data centers is certainly one. I mean, global trade picking up is another. So I think there's plenty of good reasons to like this fund, and it's been one of the better performers in the last 1 month.
Okay. I like that. I like that a lot. All right. Well, listen, Aniket, you always bring it. You always bring a great list. We love hearing it, and you always bring winners, and that's what I know the audience really prefers as well. So, but we can't thank you enough for coming on. We can't wait to have you back though on buy, hold, sell, and we do hope you
write those predictions down, Todd. Would you write those things down?
Absolutely. All 4 of them are going to be in the description. We invite everybody to check out Biz Talk Today, BTT. You can watch us on Stir, on Avo. We're on Dingo TV. We're on a number of them. Anoki.
Dingo TV. You're on Dingo.
Dingo TV. That's right. That's right. So we're all over the place, and obviously you'll be able to hear us on the audio side through Apple or Amazon or Sirius, whichever podcast platform you prefer. But we want to thank everybody for joining, Aniket for joining us today. And Aniket is the head of ETF Data and Analytics over at CFRA Research. Go to CFRAResearch.com to learn more. So on behalf of Tobin Smith and Aniket Ullal, I am Todd Schoenberger. We want to thank you once again for joining us today on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, hold, sell, brought to you by CrossCheck Management.